Hey, what's going on, guys? Bomb Mentality here, and today I want to talk to you about a trade I took on the VIX, and also my thoughts on VIX and VXX, and how to take advantage of periods of market fear, and in different ways. And I want to talk to you a little bit about my experience on how that's been. I traded VIX through the financial crisis, or better yet, the coronavirus crisis that just happened last year. And I've improved on my strategies, and I want to just give a trade I took this week as an example of that. And also, I usually like to wait a few days after the trade so you can see potentially, how I could have done better, or how you could do better in the future. So we'll go ahead and get onto it here. So I'm going to pull up the VIX. If you don't know what the VIX is, it's a volatility index. Think about it like this. A lot of people think about this as an inverse of the SPY. So if the SPY goes up, the S&P 500 goes up, then the VIX should go down. But it's not exactly an inverse. It's more of when people are fearful, the volatility index goes up so that they could use that as a hedge versus otherwise. And normally people are fearful when the market's going down. If it's going down for an anticipated reason, the VIX normally doesn't increase that much. But if it goes down sharply and quickly, it'll increase a lot, and especially depending on the catalyst too. So that's a little background on the VIX there. I'm going to go to the 20-year weekly. You see back here in 2008, I got some alerts on here. I'll just cancel those for now. This is the 2008-2009 financial crisis. We hit a high of 89 in the VIX. You'll notice that, we see a ton of sharp parabolics here. Here's the coronavirus. Crash essentially that happened back in March, April timeframe, February, March, April. That's this, and it almost hit as high as the VIX was. But as you can see, it came right back down, and so did it previously back here in the 08-09 financial crisis. So one of the important things you need to know about the VIX is pretty much it's always going to go down eventually, right? You could say that with most stocks, but you could see you're going to see sharp periods of volatility, parabolic action, followed by a swift return to the norm once whatever people are freaking out about stabilizes. So the VIX, one thing you need to know is that if the VIX is ripping to the upside and SPY is going down, if SPY slows down to the downside but still goes down, VIX will still crash, okay? Because in order for the VIX to get these huge parabolic moves, you have to see consistent, strong selling of the SPY. As soon as that selling slows down, or the SPY's selling, slows down, the VIX will start to level out and start to turn right back around and head back to the downside, right? We'll just zoom in here on the 08-09 financial crisis here. I'm on the weekly time frame, for example. You can see we had several weeks of just the VIX moving up, going parabolic right here, right? And then as soon as it had that first crash, it had a bounce, never broke the highs, and since then it rolled over, okay? And so you'll notice we spent, 6, 7, 8, 9 weeks up here, over $60 on the VIX, before it started to roll over and pull back. Let's zoom in on this 2010 parabolic here on the weekly. You'll see the VIX moved up. This red line I have right here, this is the $35 mark. I just have used as a reference. So we ripped over 35, pulled back, ripped over it again. We had 2 closes over 35, 3 closes if you count this green candle here. After that, we peaked over it during the week, but then it quickly went back to previous levels, okay? And I'll just zoom out, and as you can see, this consistently happens over and over again. Whenever there's a high period of fear in the market, you're going to see the VIX rip to the upside. You're going to see the SPY probably move to the downside. But as soon as the SPY levels off or starts to rebound, VIX is going to tank. So the edge on the VIX is to the downside, not the upside, right? Sure, if you picked up, you can't buy shares of the VIX, but if you could pick up shares at $12, that's a low risk entry, and you can sell the 20, 25, 30, 35, right? But it's easier to wait for a volatility event to happen and then take advantage of what happens than to sit here and bet on a volatility event occurring within a specific time frame. So something to think about. So that brings me to this week and what I did on the VIX. So understanding this, that the VIX moves up on times of high periods of fear, mostly headline driven, and it quickly falls off. A little bit of history here is in 2020 when we had the coronavirus crash. I'm going to zoom in here. We had the coronavirus crash, and you saw the SPY get absolutely destroyed back here down to 218 and had a quick recovery. you'll notice that on the weekly on the SPY, you see how many weeks it took to get back to prior levels on the SPY to get back up here to 340. 20, 30 weeks, right? Look over here on the VIX, it had a quick spike over the course of a month, right? Since each of these are a weekly candle, and then 1, 2, 3 weeks, and it was already down to 40, and then 3 weeks later, it had poked through 35, right? So it crashes a lot faster than the SPY is going to rebound, and that's something you need to keep in mind. And as the SPY has been climbing here, the VIX kind of leveled out and settled down below that that $25 level. So my trade on the VIX is whenever the VIX gets over 35, I start to get interested. You see, it's done that multiple times here in the past. When it gets over 35, I'm interested. And especially if it breaks over 40, I'm extremely interested. But the play that I took on the VIX is as follows. Man, we're 6 minutes into this. I didn't want to take too much time getting to this point. But here's what I did. So what I did was on January 29th is I sold a call vertical spread. So sold that for premium. And of course, as you know, I'll just go through this here. You'll see the date and time I sold this here. Now, one thing I will say is before I opened this trade, I was in my chat room talking to the guys and explaining my thought process and why I found this to be a high risk reward setup. That's essentially what I just explained to you now. When you look at the VIX, you see every parabolic is quickly sold off on a bounce. Even with significant volatility events like the 08-09 crisis and also the early crash we had in 2020, it wasn't able to stay afloat. So it's a very high risk reward setup if you're on the bearish side over $35, okay, on the VIX, right? So what I took was we had, and I'll just go to the hourly here so you can see, we had this run up on the VIX. As soon as it got over 35, my alerts are going off. So what I ended up doing was on this day right here on the 29th, when the VIX was at like 35.44, right around where these two red lines are at, I went ahead and opened my position. Which is the position I'm showing you now. You can see how it turned out, right? So I went ahead and sold that call side vertical spread, which is a bearish position. I want this spread to expire so that the side of my short calls, the price will be below that 35 strike is what I'm looking for. So I sold 10 contracts. I sold the 40-35s. Of course, my maximum profit is you take my dollar credit. With options, you multiply that by 100. So you take the difference between what you sold the calls for and bought the other calls for. That's $1. So that's $100 times 10. Max profit is $1,000. And then look at to calculate your maximum risk, you take the width between the strikes. So 40 subtracted by 35 is 5. Go ahead and subtract that dollar credit that you collect. So $4, which is 400 times 10. My max profit is 1,000. My max loss is 4,000, right? $4,000. And so what I ended up doing, and so, if I get max profit, that's a 25% return on investment, right? If you get 50% return on that premium, you're looking at a 12.5% profit, which is what I ended up getting. So I sold 10 of these VIX, not puts, it'd be calls. I always say puts because I'm so used to selling puts all that week, but it's calls. So I sold this call vertical at $1 credit for 18 days till expiration, okay? I believe it was February 19th. So I sold these for 18 days till expiration, and we'll just jump into how that turned out. So immediately when I open up a call vertical like this, I go ahead and just set limit buy, good till canceled order. So it's always out there to buy me back at 50% premium. Because if there's a very quick volatility event that moves in my favor and I can get a feel for half the premium in a shorter time frame, I'm going to take that. Now, if I've been in the trade, 50% of the time, so I've been in the trade 9 days, I'm not going to have that 50% order. I'll probably have a order to buy me out of the spread if I had 70% profit of my premium. 70% when I'm able to realize 75% of that $1,000, then I'll set that order out there. But initially, I just set it at 50% because if there's a crazy crash in the VIX, which is what I want in my case, because when I sell that call vertical, I want the price to be below 35, right? I want it to go as low as possible. If we get a quick headline about stimulus or something that the market responds positively to, and let's say it wicks down from I entered right here, it wicks down from 35 to 29, really quick, and then gets bought back up or something like that, I want to catch that fill. Because if I can keep this $4,000 risk off the table, if I can get this off the table in of 3 days out of the 18-day option I sold, I would rather do that if I can realize that sooner. So I set that order for 50% of the premium. I ended up realizing that in just 3 days. So when I sold the option, the call vertical here, and I was able to realize that profit on this day down here on the second, it was at like $26.40. So I sold that, and I had 18 days on this option, guys. I could have waited 18 days for the VIX to fall under 35. It did it day one and never could reclaim. Every single day this thing sold off. So this was a very high probability setup. Wish I got more size on this thing. So I set that order. I did realize 50% of the premium in 3 days on the 18 days to expiration option. Here's some statistics about the VIX. I just went and calculated, and I wanted to explain to you guys. I showed it to you in the chart for you visual learners just a few minutes ago, but this will talk about just a little bit about the statistics behind this, right? So the number of weeks the VIX has closed over 35 in the past 12 years on the weekly time frame is only 38 times in 12 years, right? So when I zoomed out on this chart on the weekly, go back and count since 2009. Go to this 20-year chart. Go back and count since 2009 how many times the VIX has closed over that red line, that $35 mark. That's it. Then you'll get the number 38. Number of weeks in 12 years, that's 624 weeks in 12 years. So you're looking at 94% of all weekly candles close under 35 on the VIX. That's 94% seems like a high probability setup. Now, just to let you know, before you go like betting your mortgage on the next time VIX gets over 35, you need to know, make sure you sell for the correct duration of time. Go back and you need to calculate. I'm not going to do it in this video. I'm sure I'll do it in another video. The exact percentages based on this history we have here. Let's however many 10, 12 years you want to go off of. How many consecutive weeks the VIX has closed over 35, and that's important because during times of high volatility, like the 2008 crisis here, right, or the coronavirus crisis here, you don't want to sell like a 1 week till expiration call vertical with your $100,000 worth of risk, and then you blow up because you didn't take into consideration that there has been periods when the VIX has closed multiple weeks in a row over 35. So you need to make sure you sell to cover this width, right, and this width here. And make sure you sell those call verticals for long enough to give the time VIX to fall in case it's some crazy black swan scenario like the coronavirus crash or 2008, 2009 crash. Does that make sense? I hope that made sense there. I'll go rush through the rest of the end of the video here. So my situation with the VIX was I went ahead and opened that play on this day. Now, how I like to enter short side setups is I don't like to add down. I like to add up. So I had, $4,000 of risk here. And as we went higher, I would have added on more risk. If VIX broke 38, 40, 45, 50, I would have added more risk and sold for more time because it's a high risk reward setup. Because as we know, over time, the VIX is going to crash back down and it's just going to hit that bottom line baseline number. So 94% of all weekly candles on the VIX close under 35. This is just, my order windows here. I screenshotted for you guys. So I ended up realizing 50% of that $1,000, which is $500. Only held for 3 of the 18 days I sold this for. So in 1/6 of the time, I bought those back at 50% credit after I sold them for $1 that I showed you up above. Another thing I want to just talk about before I go ahead and end this video is the VXX. So on the VIX, you can't actually trade shares. You can only trade options. I do not recommend, I repeat, I do not recommend playing calls or puts on the VIX. Is it possible to make profit? Yes. However, it's just not a good trader. During the coronavirus crash back in early 2020, I was buying puts on the VIX and I was playing it that way during all this craziness. And I did make money, but it wasn't nearly as much of it should have been because everyone knows the VIX is going to go down. So they're going to price those puts pretty accurately because they're assuming a lot of risk if they're selling puts. So it's more difficult to make a significant amount of money on the VIX doing this. So here's what I recommend. If you're trading VIX, sell premium. So you want to be the one, if you want to take a bearish position, sell that premium, sell those calls, okay? Or the call verticals or however you want to do that. I would not be buying options, puts to the downside. They just don't seem to pay as well and they're kind of really hard to trade. On the VXX, here you can actually trade underlying stock on it. So if you want to do that, you don't want to worry about theta decay and even if that'll be on your side if you sell premium. You don't want to worry about options or low liquidity, which is a big problem with the VIX. Your order will be sitting there for an hour before it gets filled because of liquidity issues. But for VXX, you can trade stock. Now, over that time frame, I sold. Remember, I opened my call vertical on the VIX here at in this day, right around this area. Same chart pattern. They're identical, right? But with the VXX, you can trade stock. And just so you know, the decrease from the 2150, which is about where I sold my call vertical for, down to the current price, is about 23%. So if you shorted some stock here, which is what, looking back, I should have traded this in tandem with the call verticals. You cleaned up. This is one of the easiest fades. You don't got to worry about short squeezes or anything like that. This is one of the easiest fades to just cover down as the market continues to stabilize and fears eradicated. So we're 15 minutes and 50 seconds in this video. My main point that I'm trying to communicate is to look to take advantage of the VIX when it reaches those high probability setups. So over $35 is what I recommend. Over 40, it gets better, and the higher it goes, the better it gets. Look to sell premium instead of buy it, and look to get as much time in those options as you can. But as you saw, for me, I could have just been still holding this. I'd be up, 90% of the premium. So instead of $500, $900, right? Because of how heavy this has gotten hit every single day since then. So that's just, kind of like a live and learn thing. I was dead on with my entry. I entered up here on this day, but with the exit, I wish I would have got more size. We always look back and wish we would have got more size that I could have taken advantage of. But I wanted to throw this out there because I don't really see a lot of people talking about trading the VIX, or people who figured out how to trade this. This is the way I like to do it. And so I guarantee you, if VIX gets back over 30, I'm going to have a ton of alerts ready to go and orders ready to go. If we get over 35, I'm definitely going to be getting some size, selling premium as high as possible, as far as possible, because you saw the statistics. It's just a high probability setup. Also, if you want to trade shares instead, you don't want to trade the option side, you can look to short this. Just keep in mind that it decays differently than the VIX. Overall, the short side has the edge. As you can see, we have a consistent downtrend, but it's not the same supply and resistance, that the VIX would have. It's a little bit of a different chart on the big picture. So that's pretty much all I got for you guys. I didn't plan to keep you here for 17 minutes, but I hope this helps and gives you a trade idea for the future. Remember to continue to stay focused on developing your bot mentality, which is the trading mentality, guys. You got to learn to control your emotions and be robotic and trade like a machine, guys. I'm out of here. Deuces.